Have you ever wondered how taxes affect your investment returns? It's a question that's pondered by many. While investing can be a brilliant avenue for growing your wealth, it's crucial to comprehend how taxes might nibble away at your returns. Taxes, quite like termites, can slowly but surely eat into your investment gains. Understanding this dynamic is key to maximizing your wealth growth. So, let's delve into the world of taxes and investments, shall we? To begin with, you need to know that not all investments are taxed equally. Let's dive into the world of investment taxes, shall we? First, consider the different types of investments. Stocks, bonds, real estate, each have their own tax intricacies. For instance, if you sell stocks or bonds after holding them for a year or less, any profit you make is considered a short-term capital gain, which is typically taxed at your ordinary income tax rate. On the other hand, if you hold on to these investments for more than a year before selling, your profit is considered a long-term capital gain, and it's taxed at a lower rate. Now let's talk about real estate. When you sell a property, you pay capital gains tax on your profit. However, if it's your primary residence, you may be able to exclude part of that gain from your income. But the taxation story doesn't end there. The type of investment account you use also plays a role. For example, profits from investments held in a standard taxable account are subject to capital gains tax. But if you hold your investments in a tax-advantaged account like an individual retirement account or a 401k, you could defer or even avoid paying taxes on those profits depending on the specific rules of the account. Remember, the type of investment and the account it's held in can greatly impact your tax bill. Now that we understand the basics, let's talk about how taxes can eat into your returns. Imagine you've invested £1,000 in a portfolio that returns 10% annually. Without taxes, you'd have £100 in gains at the end of the year. But let's say you're in a 25% tax bracket. Suddenly £25 of your gains are going to taxes, leaving you with £75. That's a significant reduction, and this simple example demonstrates the importance of considering the after-tax return. It's not just about how much your investments earn, but also how much you get to keep after taxes that truly matters. This brings us to the concept of tax efficiency. It's essentially the measure of how much of an investment's return is left over after taxes. The more tax efficient an investment is, the more of your returns you get to keep. Some investments are more tax efficient than others. For example, index funds and exchange-traded funds are often more tax efficient than actively managed funds. That's because they tend to generate less taxable income, allowing you to keep more of your returns. It's clear that taxes can take a significant bite out of your investment returns, but there are strategies you can use to minimize this. Remember, it's not just about making money, it's about keeping it too. So let's dive into how you can make your investments work harder for you. So, what can you do to keep more of your investment returns in your pocket? It's a question that many investors grapple with. Fortunately, there are several strategies that can be used to minimize taxes on investments. First off, consider holding your investments for longer duration. Why? Well, by holding on to your investments for more than a year, you qualify for long-term capital gains. These are usually taxed at a lower rate than short-term gains, which are taxed as ordinary income, so patience can certainly pay off. Next, let's talk about tax-advantaged accounts. These are accounts like individual retirement accounts or 401ks in the United States. The beauty of these accounts is that they either allow your investments to grow tax-free or they offer tax deductions on the contributions you make. It's like having a secret weapon in your tax strategy arsenal. Finally, we have a tactic called tax loss harvesting. This involves selling investments that have declined in value to offset capital gains from other investments. It's a bit like making lemonade out of lemons. You're turning a negative into a positive by reducing your overall tax liability. Remember, these strategies require careful planning and a good understanding of tax laws. It's always a good idea to consult with a tax professional to ensure you're making the most of your investments. With the right strategies, you can effectively manage your tax bill and keep more of your investment returns. To recap, taxes can have a significant impact on your investment returns. We've discussed how different types of investments are subject to varying tax rates. We've also highlighted the importance of tax efficiency in preserving your hard-earned gains. Moreover, we've explored strategies to minimize taxes, such as capital loss, harvesting, and asset location. Remember, understanding how taxes affect your investments is key to maximizing your returns. So keep these points in mind as you make your investment decisions.